It certainly seems possible, Christina, that they could be spying on us in such a way. I don't know as companies have been properly incentivized to make sure they don't.
I agree with you on that, but you have one report right now coming from Bloomberg. I'm not discounting it, but I don't see any proof, and none of the companies are responding. So I'm just going to let that sit. The markets are reacting. You're seeing the tech sector be hit quite a bit. I think the big concern out of that whole pocket or basket is Facebook. It's often been the talk is Facebook, and that's been dragging down the tech sector. Why? Facebook has said that they're going to be increasing CapEx, doubling it. They're increasing R&D. They've been faced with all these spying issues, the Cambridge Analytica scandal. You've got a lot of problems right now. They need to regain trust. Some analysts are saying it's a long-term strategy. I'm sure Scotty can weigh in on that. But overall, I'm not going to weigh in on just whether there's any spying.
We'll see what happens with this Bloomberg story that is at least affecting the tech sector as we watch it right now. But, Scott, let me go to the other big issue, which is that interest rates are going up. What do you know? Finally, I feel like I've been talking to you for years, and they've just been kind of hanging out in very low territory. But they are moving up, and that's because our economy is doing so much better. So why is the market so worried?
Yeah, shocker. I mean, everybody's flipping out because the 10-year yield is like what, like 3 1/4 maybe on a day?
Not even 3.19 as we speak.
Right, like,
which I would argue it should be.
Right, if we were at 3 1/4, imagine how much the market would be down. You know, that's what's crazy. I think the market really got used to, Trish, to your point, easy money, low borrowing costs, and just, free for all. And listen, not to say that the market's wrong about its reaction, but I will tell you that your point's well taken. The interest rates are going up because the economy is getting stronger. The Fed is on a good path. They're being pragmatic. They're being proactive. But they've also, if you pay attention to some of the Fed speak guys over the last couple meetings, they've also said, hey, if things start to get a little bumpy, if inflation calms down or doesn't go crazy, we'll step off the gas as far as, we won't hike rates as much as we thought we were. So the Fed isn't going to be the enemy here, but the market seems to think that based on the interest rate reaction that it is.
Yeah, well, at least for today, Christina.
Yeah, I want to weigh in on that because you had Jay Powell, the chairman, that said that they're still a long way away from neutralizing interest rates. So there's talking about potential climbing. We've had 3 interest rate hikes already, 1 potentially coming, so that's 4 for this year. Okay. So the major concern right now is over-tightening from the Fed. There was a report today that came out from JP Morgan. I found it very interesting. Why? Because they looked at all the markets every time Jay Powell spoke. And when he spoke, they calculated how much the markets dropped. They said that the markets, his words obviously cost a lot of money, down $1.5 trillion. I'd like to point out, though, that you have a correlation doesn't necessarily mean causation. Something to think about, that potentially these higher rates could seep in. They're already seeping in with mortgage rates, making it more expensive for homeowners, could be more expensive for car loans. And so that's why you're seeing this effect on the markets.
But isn't that the natural yin-yang that you need in the marketplace? I mean, you shouldn't have the expectation that money's going to be cheap forever and you can go buy that house next year and it's going to be just as cheap as it is this year. You should be incentivized in some way. Maybe it'll affect housing prices, but I think in the best case scenario, you have rates moving higher and higher, little by little, and, prices kind of even out. And hopefully, I mean, look at the growth we have had in
9 years of expansion right now. And just in this year alone, we're doing good. And like you said, the numbers have been great.
In history.
Yeah, the numbers are great. ADP jobs for September said 230,000, way higher than August. What is it? The number of Americans who applied for unemployment benefits dropped to a 49-year low.
I love hearing that.
So definitely a lot of strength in the market. This is just a little blip today. That's the,
So I'm glad you said that. I'm long-term bullish as well. I've been quite bearish at various times, and I'm not
short-term right now. Short-term right now.
But Scott, would you buy in this kind of environment? Are you down 300 plus? Is this an opportunity?
I would, and I think to the point that Capart's made there, every time the market has overreacted to what Jay Powell has said, who, again, I still believe he's a dove in Hawk's clothing, every time the market's dropped, 300, 500, 600 points. Hopefully we are, yes. We want to be on the same page there.
I think every Fed governor pretty much is a dove. Maybe in Hawk's
That's true, and they have to be, and that's really what the long-term trend has been. But here's the thing, Trish: every time the market's dropped, 600, 700 points on something overreactive to the Fed, that's been a tremendous buying opportunity. And I don't think this is any different.
All right,
I agree with you.
Well, go buy away.